Welcome to Investors Guide. Thank you so much for tuning in. We're here as we are every week to answer any question you have about your money, especially in the market like we're seeing right now. There's nothing to worry about. There's only one thing you need to do. Pick up your pen and paper, write down the advice you hear on the show. On the show this week, we'll help a young investor save enough to buy a home in 10 years. In our product review, we look at the L&T Equity Fund. And in our final segment, we spend some time helping NRIs solve their tax problems. All right, let me bring in Dhirendra Kumar. Dhirendra, thank you so much for joining in.
Thank you.
Before we get into the actual questions that have come in for this week, I want you to help us with a couple of other things. One is, of course, top of mind, the stock market, seesawing, high and low. There might be a lot of investors who are worried about what's happening. Another set might be thinking, is this a good time to time the market? Maybe I should be buying low, selling high. Is this something that you would recommend, attempting to perhaps buy low and sell high in a market like this?
Yes, I'm myself getting a lot of frantic calls from the people whom I know directly that they want me to help them time it. And I have no idea how to do it. And I think, the reason why one should not do it, because you will be adulterating your principle. If you are onto a long-term accumulation plan, if you are onto a long-term savings plan, then if you succeed in timing it, then the loss of faith in your own principle will be a bigger loss. And if you fail, then nothing like it. You will miss a big opportunity anyway. Either way, it is not worth it, because you have virtually no control on all the things that is driving the market. Whether it is China, whether it is US, whether the interest rates going elsewhere, or something happening, nothing much happening domestically. I don't think much has changed. But, we have absolutely no control on this. But reacting to this will mean that all that we have in our control is how long are we investing for? Are we methodical in our approach? Are we diversified enough? Are we following an asset allocation plan? That how much of my money should be in assets which I can realize anytime without much of a risk? And it is that part of my asset is not faced with any risk, and my long-term money is well spread, and is in reasonably careful hands. If those things are in place, then just keep accumulating. Don't get distracted. Maybe stop tracking your investment values for a while, because this is going to be it's very hard to when I look at it on a relative basis, I think there is every reason why you have to be extremely optimistic about it. But not sticking to a plan could be one very dangerous thing.
I know we've gone over this so many times on the show before, but I want to do it one more time. This simple plan that you talk about that we need to stick with and not get distracted from. Let's go over how to make this simple plan. If I have a long-term horizon, if I'm investing for the next 10 years, how do I pick that fund? How do I start the SIP? How do I stay focused?
It's important that first you ask yourself some questions. The money that you need for few years, within 2-3 years, should be lying in assets which are not volatile. So it should be in fixed income fund. If you do not have access to, if you can't choose one, let it lie in your bank account or in a term deposit. The money should be available when you need it, and that should, that time frame should be 2-3 years. If it is for a negotiable goal, a money which you are likely to need in 3 years' time, but you can also do with, you don't necessarily have to spend that. It can well be 4.5 years. Then you can take a little bit of chance, and have a very modest equity allocation, something like, MIP's growth option, growth plans could be the way around it. That way you'll be able to beat. So one is getting your choice right. Then comes your long-term investment, the money which you are unlikely to need for many years, for your retirement, for your child's education, which is 5-7 years away. Those goals should be into equity. You should not invest lump sum, and there one should have a very simple approach to it. If you pay tax, start with a tax saving fund. Once you exhaust your 1.5 lakh rupee investment limit, or so to say, the amount that you can invest to avail ATC, that should be your first stop. If not, if you are not a taxpayer and a first-time investor, get started with a balanced fund. And that, I think, the balanced fund today even makes sense for, even very mature, understanding investor. Because this volatility, we have been saying all these years that growth, stable growth portfolio, which we keep recommending, that will come in very handy, because when you are faced with a market like the one we have right now, it provides you all the comfort. it doesn't crumble. It is never on a free fall. Of course, it falls, but not as much that will scare you, and that is the whole idea. And my sense is that a regular investing and they are also able to capture a good part of the upside. So I would say that most people, most investors will be good, will be taken care of well with these two principles being followed.
Right, so the principles are very simple. Only invest in equity if it's going to be your long-term money. If you're not going to need it for the next 10 odd years, then it makes sense. Pick an equity diversified fund and start an SIP. Don't complicate the plan. Don't attempt to time the market. Don't attempt to sort of figure out what's going to happen over the next few weeks. If you start an SIP, keep it simple. It should take care of everything for you. Well, let's move on to our portfolio question. A similar question coming in. 29-year-old Ninad Sagar has written in, Virendra. He wants to buy a car in the next 6 months. But he's also looking to buy a home of 90 lakh rupees over the next 10 years. And he wants to plan for his retirement. So two of those goals are long-term goals. He has 84,000 rupees coming in every month. He has an EMI going out on a home loan, and he has fixed deposits of 3 lakh rupees. He's going to use this to buy that car that he talked about. He has one-to-many insurance policies, if you ask me. One, ULIP from HDFC Life for 50,000 rupees a year. A Mediclaim policy, which is a good thing. A term insurance of about 1 crore rupees that he promises he will buy soon. Now, he wants to know, should he also buy health insurance for his wife and his parents of 5 lakh rupees each? What is the best way to do that? Let's tackle that question first, because before he does any sort of other investments and starts anything else, I want him to make sure that his parents have health insurance, because if there is some sort of a medical emergency, he's going to wind up breaking his investments and taking that money out. How should he choose a health insurance policy for his parents?
One is that keeping his parents' health insurance policy with his kids and wife should be different, because that age profile can actually influence the price, the overall cost of health insurance. And then look at all the benefits, look at all the features, all the exceptions, because it has to be carefully chosen. And in his case, it could be even a family floater plan for his kids and his wife will do. But for his parents, aging parents, one has to look at all the kind of exceptions and the particular situation his parents might be in, any particular ailment or any particular situation, and that policy he should not get a surprise after buying it.
All right, so this is important. Buy two separate policies, one for yourself with your wife and child together, and the other one for your parents. So buy a senior citizens policy specific to their needs in terms of pre-existing illnesses and what you would like covered. Go as high as you possibly can. It is completely worth the money to buy a health insurance policy for your parents. Then let's take a look at his mutual funds. He has 2,500 rupees every month going into the UTI MNC fund, and he also has the ICICI Prudential Value Discovery Fund. Now, in my mind, that's not as high as he should be investing. Would you like to add a fund or so to his list, or maybe increase the allocation that he's putting in every month?
He should work on very clear steps. One is cleaning up his investment plan. He's earning well, and a good part of his money is committed to paying the EMI, which is fine. But rest of the money finding its way into insurance-linked investment plans is not a meaningful, is not a desirable way to accumulate your savings. For your ambitious needs that you have, buying a house and maybe some of the things which you haven't listed, while taking care of your retirement, that can be quickly achieved with a simple plan. Discontinue these and plan your exit. Plan your exit from these investment linked insurance plans methodically. You can save a little bit, and they are not going to be reasonably rewarding in the long run. And before that, as we said earlier, that have your health insurance and have your term plan. Rest of the money should find its way into equity fund, and that too with 2-3 funds regularly. And you should increase the quantum. Otherwise, most of your goals will not be achieved.
But Virendra, could you give him a list of funds that he can use right now?
I would say that he should get anchored to our aggressive growth portfolio with 10 years on hand.
All right, so our aggressive growth portfolio is on your screen right now. If you take a look at it, it's going to pop up. You can use this list. And if you have any more questions about it, feel free to get in touch with us. We're going to be here every weekend to help you out. Welcome back. You're watching Investor's Guide on ET now. Thank you for staying with us. It's time for our product review. And it's this week we're going to look at the L&T Equity Fund. Avan will give us a quick introduction. Avan.
Thanks, Faye. The fund in focus this week is the L&T Equity Fund. The fund was called Fidelity Equity until the businesses were taken over by L&T in 2012. The fund has been an average performer in the large cap space over the long term. But how does its performance look in the recent past? Now you'll see that its performance chart over the last 5 years shows that the red line, which is the fund, has had several ups and downs. The fund not only beat its benchmark and the category in the year 2010, but performed better than its peers even in a market downturn. However, the fund hit a rough patch in the year 2012, underperforming its benchmark and its category. But you'll notice that the fund's performance improved when compared to its benchmark the following year. The trailing returns show that the fund has marginally performed better than its category in the 1, 3, 5, 7 and 10-year periods. But the fund's performance in the last 1 year has been average when compared to its peers. Should you continue to hold on to this fund, or are there better funds in this category? Let's find out. With that, it's back to you, Faye.
All right, Avan, thank you for that introduction. Dhirendra, L&T Equity we've been tracking since the switch happened and L&T took over this entire gamut of funds. Now, the performance over the last year has not been fantastic. It's dropped down to 3 stars on value research. As investors, should we be concerned about the performance?
Yes, I would say that, it's not a disappointing fund, but it's not an, outstanding fund either. And if you look at it, it's settling very nicely as being an average fund in 8-9 years, unable to beat the benchmark in 2-3 calendar years. And otherwise, when I look at the portfolio, look at the consistency of performance, I don't find anything questionable. But at the same time, I don't find anything extraordinary about this fund in terms of its, and it definitely, is not showing any conviction either way in terms of, either being disappointing or being extraordinarily well, betting on anything which reflects very clear thinking.
So what does that mean if I'm investing in this fund right now? Should I call it a day, move my money out to something slightly more aggressive?
At least, something which reflects, right now it looks like a closet equity, index fund, or at least close to that. And, it's neither beating the benchmark in an extraordinary way and neither underperforming. So I would say that, investors definitely have superior options to choose from, and it is settling down in the middle.
All right, so it's settling down in the middle. There are superior options to choose from. Dhirendra, give us your rating on 5 on Investors Guide for this fund.
No, as in the risk-adjusted rating scale, it is a 3-star fund. Also, I'm looking at it in terms of how it has conducted and where it stacks. In the kind of volatile. Last 2-3 years, ever since it was the AMC was acquired by another management, we have seen a fund manager change, and we have seen a reasonably full cycle, a significant upside and a declining phase as well. And I don't see anything remarkable here.
All right, nothing remarkable in the L&T Equity Fund, Dhirendra Singh. You can move to better options. What I will do is put up our equity diversified list on your screen. These might be better options for you right now. Dhirendra, I want to take one quick question from a woman investor. Shruti Pathak has written in. She tells us she's a housewife. She's been investing in a ULIP for the last 5 years with a premium of 10,000 rupees a year. And she's now considering surrendering it. And she wants to know what to do with the money that she's getting. Now, she has about 1.5 lakh rupees of this money she would like to put in ELSS. Is there any tax implication to making that switch, Dhirendra?
Yes, there will be a tax implication, because taking out money from ULIP, one part is to worry about the cost, the surrender charges. But legally speaking, you have to really give up on all the tax benefit that you would have availed by investing in such an investment. I really wonder how many investors or how many people filing their taxes will be doing it in real situation. How many people will be actually giving up on all the tax benefit they would have derived by making that investment? But that is a legal position. One should be doing that. After that, I think from an investment perspective, one will be better off walking away and just try and reduce your, or marginalize your losses on account of surrender charges, which can vary dramatically after crossing a basic holding period.
Well, Dhirendra, I'm going to put up the list of ELSS funds on her screen right now. She wants similar advice for her husband as well. Well, for all of the viewers watching who have possibly been using insurance policies to sort of avoid tax or to save tax, would they be better off at this point looking at their policies, finding out how much they can recover from those ULIPs and moving to ELSS?
Yeah, I think most important thing will be finding out how much insurance do they derive, because most investors will have this false notion that they are paying so much premium that they have reasonable insurance coverage. Just try and figure out how much insurance coverage you have, and first get that cover done. Get your cover from a term plan. Plan methodically exit from an investment linked insurance, and then substitute it with, once you have done these two things, then definitely choose a good tax saving fund, invest regularly, and from next financial year definitely spread it over the next 12 months. You'll be able to average it better.
All right, so the tax saving funds that we normally recommend are on your screen right now. You can write them down, and if you have more questions, feel free, of course, to write to us on the email ID that's on your screen as well. Rajiv Kapoor has written in Virendra, very quick question: 5,000 rupees every month in HDFC Prudence for the last 5 years, but he's disappointed with the fund's returns. He wants to know, does it make sense to switch to a fund that will give him better returns, comparing it perhaps to quantum long-term equity? What would you recommend? There's a fundamental problem here. He's comparing a balanced fund with equity funds, and that's possibly why he's a little disappointed. What advice would you have for him right now?
My advice will be that he has no reason to be disappointed. He should calculate his return. I don't think investment in HDFC Prudence over the last 5 years by way of SIP will be disappointing, and this is the worst point of time when one will be looking at the investment performance. If you have time on your side, then carry on with this. Good days might be round the corner for the strategy which HDFC Prudence is following, and do nothing about it. If you don't have time, then you should be guided by your needs, and in such situation, one should be investing. One should be disinvesting or redeeming their investment exactly in the manner you accumulate your investment in equity, which is planned, methodical, regular exit from such an investment.
All right, it's time for us to wrap up this segment. Dhirendra, thank you so much for joining us. It's been a pleasure as always to talk to you. If you have a question for Dhirendra Kumar, email ID is on your screen right now. Welcome back. You're watching Investors Guide. Suresh Surana is going to join us right now to answer questions. Suresh, thank you for joining us.
Thank you.
Our first question comes in from Roopchand, who writes in saying he's currently resident of India, but not an ordinary resident. He returned to India in 2014 after working abroad for 30 years. He wants you to help him understand the tax-free aspect of the FCNR fixed deposit and the interest income that he gets. Should he declare this in his ITR too? What should he do?
As far as your FCNR deposit interest is concerned, since you are resident but not ordinarily resident, that interest is exempt from tax under section 10 subsection 15 of Income Tax Act. In form ITR 2, there is a schedule which is called schedule EI for exempt income. In that schedule, you need to disclose this interest amount which is exempt from tax. As far as your second question is concerned about the ex gratia which you have received for the earlier year, which you have received in the subsequent year, since you are resident but not ordinarily resident, any income which is received outside India or income which is accrued outside India is not subject to tax in India. So you must take care that you do not receive this ex gratia amount directly into India. You must first receive it in your foreign bank account, and then if you remit into India, it will not be subject to tax. There is no need for you to disclose this income also in your tax return, because in the case of resident but not ordinarily resident under section 5, this does not form part of your taxable income at all. So I mean, that is the care you need to take care.
Well, Momita De has also written in, Suresh. She says she bought the ICICI Prudential FMP series with a lump sum of 2 lakh rupees in August 2013. She wants to know if she could hold this for another year or allow it to redeem without any extension. What will the tax implication be of both options?
Yes, so Momita, there was a change in the tax law this year. Earlier, if you held this FMP for more than 12 months, it was eligible as a long-term capital gains, and you were eligible for the tax benefit on that. Now the period has been changed to 3 years. So you have to hold it for a period of 3 years to qualify for a concessional tax rate. So right now, since you've been holding for 2 years, if you roll it for 1 more year, you will be able to claim the benefit of the long-term capital gains if you sell after that or if you redeem after that.
All right, last question on the show. Sridharan Natarajan has written in writing on behalf of his son-in-law and his daughter who moved to Australia a couple of years ago. He tells us they bought a flat with a bank loan before moving overseas. He wants to know when the flat is actually ready and handed over, can he sell that house and what tax implications there will be? He also wants to know what tax implications there will be on his money back and LIC policies that they took before they moved overseas. Suresh, obviously there are two questions here. One is short-term capital gains tax. They've only held that property now for about 3 years. We don't know when it's going to be complete. What tax implications will they have to pay? And if they're NRIs, does that make any sort of difference?
So, Mr. Nagarajan, as far as the first question is concerned, the house property which is owned by your son-in-law and by your daughter in India, they can definitely continue to hold it, they can sell it. If they sell it after a period of 3 years, after holding it for 3 years, then whatever is the capital gains they make on that, it will be treated as a long-term capital gain. They have an option to reinvest in another house property, and if they do that, then there will not be any tax on that. If they choose not to reinvest, then they will get the benefit of indexation, and after the indexation, the net long-term capital gain will be subject to tax at the rate of 20%. They can also invest in the bonds under section 54 EC up to rupees 50 lakhs. So all these options are available. If it is sold within 3 years, then all these benefits are not available. It will be taxable as a normal business income. Also, I would like to share with you that since they are non-resident, they are allowed to remit $1 million every year out of their sale proceeds or other rental income from this property. So that also they can take benefit of it if they require money outside India. As far as the LIC policies are concerned, also there is no restriction. As a non-resident, they can continue to hold the LIC policy, and as and when they receive the maturity proceeds, or in the event of death it is received by the heir, it will not be subject to tax under section 10 subsection 10D of the Income Tax Act, subject to, of course, the specified conditions that the premium should not exceed certain percentage of the insured sum, etc. So I think on both the fronts there is no issue. There is no separate requirement for disclosure here in the case of non-resident, because these are assets located in India. As long as you report your income from these assets correctly, that is what you need to really see.
All right, that's a wrap on Investors Guide. Suresh, it's a pleasure to chat with you as always. Remember, any sort of question you have, whether it's about your taxation, whether it's about your salary, your savings or your investments, write to us. Our email ID is at the bottom of your screen. Tune in next week to catch the show. Thanks for watching.